Nexus came in on the start of the month with a bold call that it was time to buy all assets. That was after the Treasury announced it would slow the pace of bond auctions. Since then, stocks and bonds have been on a red-hot run. Today, Andy Constan of Dam Spring is back with a new call. This time, he is saying sell all assets. Andy, of course, is the CEO and CIO of Dam Spring. Andy, good to have you back. So,
hey, Melissa, thanks for me.
You're in cash now? That's what your portfolio looks like?
So what I've done is I have two portfolios, a beta portfolio, which is a long-term passive long assets portfolio. I raised about 30% cash, so now I'm only about 70% invested. And for my alpha portfolio, which is a market timing, multi-month horizon portfolio, I went short assets fairly aggressively.
What's the next move, do you think? What gets you off the sideline, so to speak?
Yeah, so I think what you have to recognize is that this Treasury surprise that we talked about on Halloween or the day after, really created a big move in assets. S&P up 8%, NASDAQ up 10%, 10-year and 30-year bond yields fell 50 basis points. The TLT went up 7%. Those are huge moves. And what I would say is that, I make an estimation of what this reduction in supply had, and it's really overshot in a significant way. So we've had limited data in the last few weeks. There's been Fed speak, there's been the presser from Powell, and there's been some, data that has been consistent with what we've known for a long time, that the economy is slowing, inflation is falling towards target. And that's really the only thing that's changed since the QRA on 11/1. And so, to me, the market has just significantly overshot, which means that once again, the impact of higher long-term rates, which the Fed has been championing for the to make their job easier, is no longer there. And so that makes me worry that the Fed is going to have to, once again, stay at current rates or even hike over the next couple of meetings. And however, and I think this is important, though the supply was less than expected, it's still huge. We have $350 billion of bonds to be absorbed in the first quarter. And we saw the auction on Thursday of the 30-year, which was the worst auction in a long, long time. And I don't know for sure whether this supply is going to get absorbed well, even though it's less than expected. So I'm fairly bearish on bonds. I would expect long-term bond yields to rise, and that'll take the bid out of equities.
Andy, it's Karen. Thanks for being on. Excellent call both ways. So I know I've read your stuff, and I know you think we're just back to the beginning of where we started, maybe it was in late July, early August, of we are going to see another QRA number that is very high, and we'll be back to this same thing again. Is that what would that be the sort of catalyst if we do get that number and a big sell-off then for you to maybe reverse course or no?
Yeah, so I think that's a long way off. The next QRA is on January 31st, and we have a lot of economic data. We have year-end, we have the beginnings of earnings season, and we have two Fed meetings. And so there's a lot of things that could cause markets to go up or down. I think they'll go down because of this supply overhang. And then come January, we're likely to see a significantly greater supply, and that should push us back down, yields back up to 5, 5.25, 5.5, and equities will struggle to stay above 4,000 in that environment. So, Andy, yes, the answer would be if we do see such a move in markets, that's when I'd get back into assets and out of cash and cover shorts.
Andy, but if I hear you right, the market, which in the last few days has certainly done to Fed funds also a lot, right? So you've put maybe 4 hikes into next year. Kind of reiterate, your view is no way Fed is near this, and we know Fed funds doesn't have to be in line with dot plots, et cetera. But is the market overreacted there?
Yeah, I mean, I think that's true. You know, we with 2 years did sell off a lot today, but certainly since, and we're back to where they were 15 days ago. But after the CPI number, 4 cuts got priced in. And I guess the big point I'm trying to make is that if long-term assets, including bonds and stocks, are easy, financial conditions are easy, the Fed has no choice but to keep the front end as tight as they can, which will be either a long pause where you get no cuts at all, or even hikes if the economics numbers start warming up as the financial conditions start moving through the market and through the economy, given how easy they've become all of a sudden.